AER, why this airline stock is set for success. This is Stockerfinance. I'm your host, David Scheuer. Make sure to follow me at Stockerfinance on Twitter for more details. Before this video starts, I want to give a quick disclaimer that this is not financial advice, but rather entertainment. I encourage you to do further research before considering taking any financial risk. Now, also, before we talk about the company and some of its details, we need to talk about value investing. Because this strategy that I'm going to be taking here and what I'm going to be talking about in the position I'm taking on this company is a value investing strategy and position. So, value investing is an investment paradigm that involves buying securities that appear underpriced by some form of fundamental analysis. Pretty straightforward, simply buying a company that has a great balance sheet that is currently undervalued and has a higher intrinsic value, or at least that's what you think the company's current standing is. And so by doing that, you're getting it at a discount, essentially. It's a strategy that Warren Buffett takes, Charlie Munger. It's a pretty famous strategy, and if you want to do more research on it, I have plenty of videos, or there's tons of stuff all over the internet, and tons of books as well about value investing. But now let's talk about AeroCap. What is AirCap? So its ticker symbol is AER. It's a global leader in aircraft leasing with 1,372 aircraft owned, managed, or on order, and 47.1 billion of total assets as of March. AirCap has an attractive order book. AirCap serves approximately 200 customers in approximately 80 countries with a comprehensive fleet solutions. And it has headquarters in Dublin, Ireland, with offices across the world. So, first off, let's just look at its stock graph here, as I always do before I really get into the meat of it. Its high today was 31.14 with a low of 29.62. It's currently priced at $29.77. A PE ratio of 3.34, a market cap of 3.86 billion. It has a 52-week high, though, of 64.86, so it's significantly below its 52-week high, but also fairly above its 52-week low of 10.42, and it does not currently offer a dividend. Now, one thing, if we go ahead and look at its pre-pandemic price here, you can tell it's currently down around 51% from its bottom price, so the bottom of the pandemic, which would be that $10.42 52-week low there. It's up 96.63%. So it's up a significant amount, and it's really recovered decently well, but still not anywhere close, or not yet super close, to the 52-week high that it hit before the pandemic. Another thing I just want to point out here is the 56.26 gain there from 2019 to 2020. And that is just to show that it was a growing company before the pandemic happened. A lot of times with these companies, you're going to look at it and say, oh, it looks great, it's recovering, but it's actually been on a downward trend for longer and before the pandemic, so maybe the company just wasn't performing well at all. But AirCap Holdings, well, it's been performing well. It was up 56% in 2019, and it's up about 26% or 30% since the beginning of 2017. And now I also just want to point out the earnings here. So it's consistently beat earnings, which is very nice to see. If you care about the ratings at all on Robinhood, as a 67% buy, 33% hold, 0% sell. Personally, I wouldn't listen to those or pay attention to them at all. Make your own analysis. But it has beaten the earnings significantly. It's a profitable company, and its earnings are coming up here on July 30th as well, so about a month from now. Now let's talk about leasing, what the company is. So they provide many different things. I'm just going to read this straight from their website. They provide new and used commercial aircraft on operating lease from our existing fleet and order book of Boeing, Airbus, Embraer aircraft. Through sale and leaseback transactions, operating leases provide major benefits to airline customers. So if you're wondering what they do, if you're a little confused right now, they buy airplanes and they lease them out to different airlines, different people, etc. So aircraft trading. Now this is something that I found really interesting. They buy and sell aircraft. So they'll buy undervalued aircraft, sell it for more, buy them as investment, similar to buying and trading cars, buying and trading stocks, anything. It's just an asset that they're trading, and it happens to be aircraft, which in the current climate with all these aircraft that are sitting vacant, all these airlines that are struggling that might need to sell some of their aircraft in order to, make payroll or to just pay off some of the debt they have, I think they could really take advantage of aircraft trading during the current economic climate. They all do asset management. So it looks like they just do services and they manage their different clients' aircraft portfolio. So they assess the marketing opportunities to negotiating lease documentation, preparing the aircraft for delivery, and managing the lease during the contract period. They do remarketing, purchasing and selling, technical management, contract management, financial engineering, securitization, services, etc. Just managing your little fleet or whatever might be there. So, next thing I want to talk about is PE ratio. And this is the first kind of reasoning for why this stock might be undervalued here. So, a PE ratio shows us how much investors are willing to pay for each dollar of earnings in a given stock. That's why PE ratio is the price to earnings ratio. Now, how do you judge a PE ratio? Well, you can compare the PE ratio. That's one way to do it. You can compare it to many different things. So you can compare it to where the ratio has been in the past. You can compare it to how it compares to the average for the industry or sector, how it compares to the market as a whole, and how it compares to similar performing companies and their PE ratio. So the trailing 12-month PE ratio of 3.56, and it was 3.41 as of 6/24, which was yesterday. I'm recording this on the 25th. Now, does the PE ratio tell us it's undervalued? Well, the level compares favorably with the market at large. The PE for the S&P 500 stands at about 19.94, so it's significantly below that. The long-term PE trend of AER and its current PE level puts it below its midpoint over the past 5 years. Current level is below the stock's high, suggesting it might be a good entry point, and it's a forward-looking PE ratio. So what is the formula for a forward PE ratio? That last thing I mentioned there. I just want to define this for people who might not know what it is. If you already know, you can just skip ahead really quickly here. Now, the formula to calculate a forward PE ratio is the same as a regular PE ratio formula. However, estimated or forecasted earnings per share are used instead of historical figures. So PE ratio usually is doing the past figures, and this is just calculating the future and potential earnings per share. So, for example, if a company has a current share price of $20 and the next year's EPS is expected to be $2, then the company has a forward PE ratio of 10 times. So it's just a way to kind of look in the future instead of looking at the past. Now, does the PE ratio tell us it's undervalued? And as we said, I just kind of went through this already. But now let's talk about the PS ratio. Now, this is the price to sales ratio, one that really isn't talked about. It wasn't even on the Google Analytics little summary there of the financials. So it's something that is overlooked pretty significantly. But it compares a stock's price to its total sales, and it's the price to sales ratio, where a lower reading is generally considered better. Some people like this metric more than other value-focused ones because it looks at sales, something that is far harder to manipulate with accounting tricks than earnings. AER has a PE ratio of about 0.83, lower than the S&P 500 average of around 3.33. And as I just read, a lower reading is generally considered better. So this is a good sign that it's at 0.83. Below the highs for the stock over the past few years, and it suggests that it's some undervalued trading compared to its historical price to earnings ratio, which it's completely undervalued compared to the historical PS ratio. So now it's time to dive into the financials. Let's do it. All right, so first off, here's the 2019 and some of their historical data here. We can look at they have a significant amount of cash on hand, about $1.12 billion of cash and cash equivalents as of 2019. I'm not going to focus too much on this old data because it's completely outdated, different scenarios. They could have spent this money, but just to point out that they do have a lot of cash, which is important for the current situation we're in. So now here's just a summary of the latest quarterly result, which was the Q1 2020 financial results. The net income of $276.8 million for the first quarter of 2020, diluted earnings per share of 2.14 for the first quarter of 2020. Approximately 11 billion sources of liquidity, over 28 billion of unencumbered assets, adjusted debt/equity debt to equity ratio of 2.5 to 1. Now, 2.5 to 1 may seem high compared to other companies, but for a leasing airlines company that deals with a lot of these large financial transactions and really manages debt there, it's really not that big of a deal. Debt to equity ratio, it really depends on the market you're in, the company you're dealing with. So 2.5 to 1 is actually a pretty reasonable debt to equity ratio for this type of company, especially in the airline industry. It's a secured debt to total assets ratio of 19.96, 100% of new aircraft deliveries through 2021 already leased. Now that is important to me, and this is something that I really like about this company, is they've leased all their aircraft through 2021. So the companies that have leased them, no matter what's happened already, they have to pay those leases. If they want to break them, it's probably going to cost them a ton of money. So they're getting revenue no matter what. They're not an airline. this company is not an airline. They do own a little bit and some shares in airlines, but they are not an airline themselves. They operate as a leasing company and they trade airliners or they trade planes, etc. And so the fact that 100% of new aircraft deliveries through December 2021 have already leased. So a year out from now, they've already been leased. That, to me, is a really significant point there. New technology aircraft comprise 59% of the fleet, which means they're pretty up to date on their technology in terms of the aircraft that they're buying. The average current lease expires in the third quarter of 2027, so they have still a while till they have to deal with these lease expiring and find new people to take over them. So by then, hopefully this whole pandemic thing will be over and it'll be a lot easier for them to find new people to lease planes, and that's 2027. So more than 6 years from now. 99% fleet utilization rate for the first quarter of 2020, which is great. 27% increase in diluted EPS year over year, 14% increase in book value per share since March 31st, 2019 to $73.69. Now remember what the current price was. It was below $30 and their book value is $73. And their price to earnings ratio as well as their price to sales ratio indicate that they're potentially undervalued. Now, that's undervalued and their book value is way above the current value, with 100% of their new aircraft deliveries through December 21 already released. The average lease is staying all the way through to the third quarter of 2027, and they utilized 99% of their fleet. They also saw a 27% increase in diluted EPS year over year and a 14% increase in their book value since March 31st, which was really around the beginning and the peak of the pandemic here in March. So now I want to read their little statement about the pandemic, since this is really important for the industry. And I'm just going to kind of read it really quickly. If you don't care for this, you can move on, but I think it is interesting. The pandemic is creating significant challenges for the global aviation industry and for economies around the world. We would like to express our support for those directly affected by this illness and those whose jobs and businesses have been impacted. Let me skip through this a little bit. AerCap entered this crisis in a position of strength, with a strong balance sheet and liquidity position, an attractive aircraft portfolio, and high-quality customer base, including many of the world's leading airlines. Most importantly, we have unrivaled operating system or operating platform with a strong track record of successfully managing through challenging environments. With approximately 11 billion sources of liquidity, over 28 billion of encumbered assets, and a record low average ratio, a debt ratio of 2.5 to 1, we are well positioned to weather an extended period of turbulence and support the recovery of the airline industry in the future. That is great. They're confident about the future, and they actually didn't give guidance in this quarter, but to me, this is the guidance that they gave. I mean, this is guidance right here. They're saying that they are well prepared. They gave numbers of why they're well prepared. I think that's all we need to know. So the fact that they didn't give guidance for the future this quarter, because it's just so hard to tell what's going to happen, this to me is their guidance, even though they didn't officially call it guidance. So now let's go through some of their books here. Now, the arrows that are pointing to the left show a gain since 2019, and if they're pointing to the right, that is a loss since 2019, or it's decreased. So basic lease rents have slightly decreased to 1,030, and these are in millions of dollars. That'd be 1.03 billion. We saw maintenance rents and other receipts increase. We saw total lease revenue increase, which is great. A net gain of sale on assets. The fact that lease revenue increases is great, because that just proves the theory that 100% of their planes are leased, which means no matter what happens to these airlines, they have to pay their lease. It's a signed contract. They can't get out of that. No matter how many people they're flying, they have to pay their lease. We also saw overall total revenues and other income increase from 2019 to Q1 2020, which is great. That at the beginning of this, and really during a lot of the craziness of this during March, the revenue and income still increased since 2019, the same quarter 2019. So now let's look at basic lease rents and interest expenses. Now interest expenses lowered, which is nice, and basic lease rents also lowered slightly, but not by much. And total selling, general, and administrative expenses also lowered since 2019, which is great that they're cutting costs there. So now other expenses. The increase was primarily due to an increase in leasing expenses as a result of higher lesser maintenance contributions, partly offset by a decrease in maintenance rights expense as a result of lower maintenance activity during the period and lower maintenance right asset balance sheet. and they're more offset by maintenance revenue, which is great. So asset impairment charges recorded in the first quarter of 2020 relative to sales transactions and lease terminations were more than offset by maintenance revenue, which is fantastic. And that probably has to do with all the different airlines shutting down, and all their airplanes are simply just sitting around. And so they're charging maintenance fees, and so all the liners that are just sitting around is still generating them income, which is just substantial since they're charging these maintenance revenues for it. The effective tax rate was 13.5% compared to 13%, so just a slight raise there. And taxes raised all the time, not too big of a deal. All right, so again, their book value is substantially above their current value. We've seen multiple things now that have been indicating that, one, their books are healthy, they're profitable, they've actually made more money in 2020 than 2019 in the same quarter, they're lowering expenses in some parts, they have a decent debt ratio, and 100% of their aircraft are leased, with most of them leased all the way through 2027. Their book values significantly ahead, and the PE and PS ratio both indicate undervalued company. These are all great signs, and this is simply by just looking at the numbers. So now total cash on cash equivalents, which is great. So 4.8 billion. And the great thing here, too, is that their liabilities are less than their total assets by a pretty decent amount there, by about $10 billion. So that's always a good sign. Now, in March 2020, we borrowed $4 billion under a senior unsecured revolving credit facility. Oh, and one thing I want to focus on here is their total liabilities is $37 billion. Their total assets is $47 billion. But if we go all the way back and look at the market cap, it's really not significant, and I believe it's just their market cap doesn't make any sense for them to have this much in assets and for their book value to be that much above what their current price is. So I think that, again, just shows, when looking at their market cap, that it's just simply undervalued right now. Now, in March, they borrowed $4 billion under a senior unsecured revolving credit facility. This resulted in an increase in total cash equivalents, and restricted cash, debt, and total liabilities during the first quarter of 2020 and April 2020. We repaid $3 billion of the outstanding amount. So that could have to do with how much cash they had right there. But they repaid $3 billion of the borrowed money already. So they only have $1 billion more to go, which is, that's great that they repaid it in, a month. As of March 31st, AerCap's portfolio consisted of 1,372 aircraft that were owned, on order, or managed. The average age of our own fleet as of March 31st was 6.2 years, 2.5 years for new technology aircraft, which, as we looked at it, I think it was 56% that it said, which was new technology aircraft that's only 2.5 years old. So that's great, because it's the newer technology, the newer the aircraft, the more people are going to want to lease it, which clearly leasing airplanes isn't that big of a deal since 100% of them are leased through 2021, the third quarter of 2021. 11.5 years for current technology aircraft. And the average remaining contract lease term was 7.5 years. So they're pretty long leases there. Now, we already talked about the debt to equity ratio. Don't have to say much here. And their total revenue is $1.2 billion, which is, again, the revenue is increasing. Their total lease revenue is also increasing, which is great to see. Now, state of the airline industry. Oh, and one more thing I want to focus on here. If we go back right here, you see Boeing 737 MAX delays. Well, there's something I want to note about that I forgot to throw on here as an image. But they did order about 50, I think it was like 50 airplanes, 737 MAXs. Now, obviously, there's crashes, there's huge problems, controversies with those that have to be going under review. But the great thing is the people who leased them from them, so they already pretty much leased the planes out as they ordered them. If those people don't lease them, then they will not accept the order from Boeing, and so they don't have any loss. That is huge. Instead of receiving 50 airplanes from Boeing all of a sudden, and since the airlines are struggling, they will be struggled to maybe to find leases for those airplanes. If they don't have leases for them, or if there are people that are leasing them back out, they don't have to worry about taking the order or taking that loss or cost at all. Boeing just won't be able to deliver it to them. It must have been part of the contract that they made. But that's what it said right below here on their whatever this is, the Q1 results. So now let's talk about the state of the airline industry, which is something that a lot of you are probably wondering about, since it's had a rough ride, to say the least, the last few months. So it is struggling. I'll admit, there is some downside to this company. The airline industry is struggling. They're a leasing company, not an airline, though. This is a huge advantage. Again, leases are a contract. They have to keep paying these leases no matter what. And because they like to trade aircraft, this could be perfect. They have a lot of leverage with trading aircraft. If a company can't pay the lease off for whatever reason, they could just say, whatever it might be. If they own, they could give them, I don't know, whatever it might be. I think it's a great time to be trading aircraft and take advantage of perhaps the lower prices or the struggle that some of these airlines are going through. So in the future, they could lease out any more planes or sell airplanes back to airlines at a higher price. I don't know. I'm just kind of brainstorming there. Being a European company helps as well. They've handled a lot of this decently well, and there's a lot of great bailout incentives, etc., if something were to happen there. And because they do have some, they own a little bit of Norwegian Airline. Think about it, they own 50% of that company. Pretty small company, though. But I think just the fact that if those airlines get bailed out, it'll help AER as well, who owns pieces of them. Passengers on flights are starting to increase again. If we look at this here, you can tell this is passengers on flights, and it says pre the pandemic and then post the pandemic. So it's just estimates here, but we're kind of in that 2020 post COVID right now, kind of right there, that 23.1, and it's estimated to be at 30.1 by 2021. Which is great to see that it's growing back. And as you can see, the airline industry was growing substantially. In fact, it doubles about every 10 to 15 years in size, which is a great growth rate. An uncertain future due to the current circumstances. It's absolutely an uncertain future, but from what I've seen, it seems like things are starting to get better, especially in Europe. Now, it differentiates around the world based on government handling of situations as well as pandemic restrictions, state of airports, airlines, etc. before and after this whole situation, etc. So it all really depends on different geographical areas and what's going on with the pandemic in that area. So, in my opinion, this stock is not a short-term winner. I think there is some short-term, just the fact that it's undervalued, you could see some short-term gain, but who really knows? It's hard to predict that. But long-term, as the airline industry recovers, these leases are going to be still paying. They're still going to make revenue. I think this next earnings, I'm hoping, are good. It's going to be interesting. I think it's July 30th is their earnings pre-market. So I'm going to stay tuned to that. Maybe I'll live stream it or something on this channel. And yeah, I know this wasn't the most exciting company to analyze, but I hope you still enjoyed it. Thanks for watching, and please subscribe. If you like these videos or want to recommend a stock for me to do an analysis on, please follow me on Twitter at Stockerfinance and tweet or DM me. Anyways, make sure to subscribe, hit that like button, comment below your thoughts, and I will see you guys in the next video. Peace out.